Hi friends, good morning, Saral traders. Today I'm going to cover some of my deep pullback trades and some of the trades, bullish trades that we are going in 2025. Basically, in this system, what we typically do is we take a position for a stock or instrument for 1 year, and we hedge it. We hedge it in a manner that our losses are capped. Now, there are various ways to do the hedging, but just for the sake of it, I'll explain. What we are going to do here is if we go long on something, we are buying something, we will hedge it. Hedging is basically, buying insurance against the down move. You can buy puts, or there are various other ways of doing that as well. You can do multiple ways. You can do pair trade, you can do options, synthetic calls, or you can do debit spreads or credit spreads also. Depending on how you want to hedge it, we'll leave that. You can reach out to me if you want to know more about it. So the first one is Apple. So if you are bullish about the markets, Apple is going to really lead the show. So this is currently at 230. Now, if you take a long-term position, a 1 year position currently, the hedging cost varies between 5 to 7%. Now, typically, the target for this, if the market goes up and makes a new all-time high, can be 290 to 300. So this is one thing that I'm watching. Apple, Apple is in a corrective phase right now, so this is a good entry point also. You can start buying it. And in case the stock goes down, say around 7 to 10%, what you can do is you can roll over your hedges. So rather than staying in this position, and if you're still bullish, you think that there is a counter move going to come, you can just hedge, roll over your hedges. The other stock is a defensive stock, which is Mondelez. So Mondelez is a leading fast moving consumer goods company. It has been in a corrective wave right now. So it moved from 61, gave a high of 77, which was, say, almost 20-25% move. Then there was another move from 64. This one was 76. So you are looking at another uh, possibly 15% move. And then currently, it's correcting from 76. It has corrected to 55 and now trading at 57 or something area. So this correction is a deep correction. It's a stable company, good products. It owns a lot of leading brands. So this one is something that you can go, and the current hedging cost here is around 6 to 7 to 8% depending on how much hedge you want. I typically buy it for 1 year. And also it gives a dividend of around the current dividend yield is around 2%. So if you're looking at it, the cost of hedge minus dividends is only going to be around uh, 5 to 7%. So this is a good pullback trade that you can go for on a year. Now, again, it can keep going down, and if it keeps going down, you have two options: either to stay, win the trade and take that drawdown, or you can just roll over because your max loss is always capped. You have capped your max loss at 5-7% when you're taking the trade. So you can roll over your hedges or you can stay in that trade, depending on what your risk profile or appetite is. So this is one trade that is looking good. I think there is a lot of beating down has already happened, and then this can be taken. Another one, if you're looking at ETFs, is the emerging market index ETF from Brazil. Now this one has broken a very key support, and it has come down sharply because of the currency risk that played out. Now it is trading at 23.5, and if you look at the year-long hedges, you are looking at around 6 to 9% depending on how much hedge you take. This one is a very volatile ETF. Brazilian market, high inflation, and then high inflation means when the stocks move, they rally very fast. Typically, if you look at this rally from 26 lows, it went up to 31 in matter of few weeks. So it gives very sharp rallies. Here also, it was at 27, it went up to 29.5. So almost, 9 to 10% rallies can come very sharp on it. 9 to 20% rallies, it gives very, very sharply. It's an index. It has some leading companies. The current dividend on this one is around 7%. So if you're hedging with say around 6-7% and you're getting dividends, so typically this trade is almost very less cost in it. The only cost is to probably holding it and dividends will go. So you may not make anything, but this was a very good setup. Anything can happen. This can keep going down and it can go further down. It can happen. Anything is possible, but this is a good risk reward in my opinion because your risk minus hedges is going to be very limited. So this is one. The other one is Baba. Now Baba is a Chinese large cap, one of the largest e-commerce companies from there. Stable, I mean, very volatile in terms of dollar market and kind of volatility it has. But every Chinese stock or Chinese item, I should say, is volatile. Currently, it is trading at 80, and the lows, the support area for it is around 74 and lower. I generally swing trade it, so I took a trade and got out at 4% gains. That's typically what I do. But if you have to take a risky trade, you can typically buy Baba with a one year view. The first target for it is going to be 120 to 115, and the next one on the downside, there is seems like 74 to 70 will be a very strong support area for it. So you can take this trade. The cost of hedge again is around 10%. I think there is no dividend in it. Yeah, there is zero, well, there is 1% dividend. So basically, this is purely going to be a view that is a trade that you are going to take based on uh, the the momentum. So these are the trades that I am currently watching. There are some other trades also which are in more safer companies like relatively safer. I mean, Coca-Cola is one. Coca-Cola was at high of 73. It is down to 60. It made a low of 60 and now currently at around 62. So if you think that Coca-Cola is something that you want to own, it can go up 10-15% in a year minus hedging cost. You can still make easily 10% kind of gains because that hedge that you will take will also have a value when it goes up because you're buying year-long hedges. So typically, the risk reward ratio, Coca-Cola is at 62. Suppose it goes to 73. You are looking at possible 10%, so you will make around 7 to 8% on that, and minus, you will also have the cost of hedge. The current dividend is around 3%. So you're basically, if you're paying around 7 to 8% and 3% you're getting in dividend, the cost of trade is only 5%, and you're protected from any downside move. Now, significant downside move comes in, say, it goes to 58 or it goes even lower, you are capped, so you can decide whether you want to roll over or you want to keep it or not. So that is one way of doing it. Similarly, another long-term trade, if you want to trade, is Pfizer. Pfizer, I know, is a hated company. It has been doing nothing for a while, but Pfizer also, you can take a long-term trade in it for 1 year. The current cost of hedging is only 4% minus dividends. So typically, you're getting a year-long trade, and if this goes well, it can possibly do 32, 31, and it can even do 35 if everything remains okay. So this is my opinion. These are the trades which I will take. I may or may not take definitely, but these are on my radar. I trade these very, very regularly, these items, these stocks. So if you have any questions, let me know. Thanks.